Welcome to the Impact Room, brought to you by Douglas Jackson, who help you hire more impactful, diverse leaders who stay for longer and are more successful. The Impact Room is a business, CX, and leadership podcast where exceptional, diverse, and impactful leadership and wisdom is shared. We dive deep into pressing topics that impact your customer-led business, featuring interviews with CEOs, COOs, Chief Customer, Chief People Officers, directors, influential leaders, and subject matter experts who share their lived experiences, top tips, thoughts, advice, and industry trends to help elevate existing and future talent. So let's dive into our next episode, and please don't forget to like, subscribe, or share if you enjoy this content. Thank you.
Welcome to the Impact Room. So today I have the pleasure of introducing Gavin Lillywhite. Gavin is heading up distribution for Axio, and let's get straight into it, Gavin. So tell me a little bit more about yourself. What would be your elevator pitch?
Yeah, hi John. So very nice to be here, and thank you for the opportunity to talk a little bit more around cyber and specifically cyber physical damage, which we're going to go into. In terms of elevator pitch, a very quick elevator pitch around Axio. So Axio is a cyber risk assessment and quantification company where we help clients, enterprise clients, with their cyber enterprise risk. Basically, we assess their profile, their posture, so-called posture against frameworks. And then what we're able to then do is to assess quantification of balance sheet risk and balance sheet exposure for those scenarios that would be the most impactful for those organizations. So work a lot with energy, oil and gas, power distribution, financial institutions, complex manufacturing, etc. It's a SaaS-based platform that we use. And then we're able to, as I say, then help clients also economically reduce loss and balance sheet exposure. So that's what we do on the client side. Then what we also do for the insurance side is taking that capability and competence, we're able to also give that same cyber risk engineering information for insurers, and brokers. Plus also what we've also just developed in Lloyds is our cyber physical damage platform. So extending on from enterprise risk, which we'll talk about and go into now, which we think is a really big both issue and opportunity for the market. So an issue for clients and lenders, but also an opportunity for the market, the protection market, particularly through Lloyds, and increasingly now starting with company markets as well.
Yeah, sure. I mean, we had a brief conversation about this not so long ago, and I found it absolutely fascinating, to be perfectly honest. So I suppose let's sort of dig into it and find out a little bit more. So tell me, what is cyber insurance and what does it cover? What doesn't it cover, and why is it essential for organizations?
Yeah. Okay. So I'm going to talk in very crude and basic terms today, because obviously, I guess the majority of your listeners will not be cyber experts.
That's fine.
So
Neither
I
am
want to put it into a language that everyone can understand. So if we talk about traditional cyber policies, what we call cyber liability. So this is the liabilities arising from a cyber breach. And those policies would typically be insuring things like restoration of data, bricking of equipment, potentially ransomware demands, fines and damages, regulatory charges, forensic costs, all those kind of things. So when you have a cyber breach, all those potential liabilities that you incur as an organization as a result of that. Plus, of course, it's very much also a service provision as well, because the insurers that provide cyber insurance also provide protection and reinstatement of services post-event as well. So it's not just about pre-event. So if we think about, traditional products, insurance products are very much sort of sold and then the claims are sort of dealt with at the time. Whereas with cyber, the embedded protection and the embedded solutions around restoration in the event of being breached are also very much sort of front-loaded as part of the product. And that's what we might call cyber liability. And if we think about that, what we probably typically see here in the UK is a big emphasis on liability. So, and obviously a lot of that's driven by what was then GDPR, the EU regulation that basically states that companies must protect sensitive consumer data. And obviously consumers have a right to be protected when they hand over their data. And that very much sort of like, sort of predicated the evolution of the cyber liability market. Within that cyber liability policy, there's also a business interruption piece, which is based typically sort of 120, 180 days of cover. And so basically, if your business suffers downtime through networks or through computer breach, etc., then obviously you lose revenue in that period. So the policy would also typically pick up business interruption cover. So essentially sort of loss of turnover in that period as well. But what's not insured in that policy is the really big capital plant. So we're talking here about buildings, plant and machinery, stock, contents, and the resultant business interruption as a result of damage to those really big assets. And the easiest way to explain this probably is if you think about if you're a power generating company. So you have lots of computer equipment that runs the plant, which would typically be insured under your cyber policy. But if you think about it, your biggest asset is going to be either your buildings and your plant, but most importantly, let's say the turbine. So the actual turbine itself. So you're talking a lead time for a new turbine, 12, 18 months, let's say, plus a cost of probably $250 million upwards, plus the resultant business interruption ensuing, because obviously if you haven't got a turbine, you can't generate electricity, and obviously you don't get revenue. None of that is insured under a cyber policy. So those assets are insured under either a property policy or an engineering policy, power policy, etc. And what we typically see within those asset policies is a malicious cyber physical damage exclusion. So what we're saying here is that in the event of a cyber breach into the network that causes damage to that buildings, machinery, plant, etc., and resultant business interruption, that is not insured. And if you think about it, that's really the biggest part of any business. That first party business interruption and loss of assets is far more critical than receive fines or damages or a couple of days outage time. So you can start to see sort of the difference in the two covers, but most importantly, you can start to see the gap in the protection market as well. So clients running significant balance sheet risk because they either have a full malicious cyber physical damage exclusion on their asset policies, or at best they might have a malicious cyber physical damage exclusion, but they will still have cover for ensuing perils. So here I'm saying that if there is a cyber breach, the actual cyber breach and the damage and business interruption caused by the cyber breach is not insured. But if that then leads to a subsequent fire, the damage by the fire or water damage, sprinklers or burst pipes or whatever, that is covered. Now, you might say, anyone might say, well, how does that make sense? But this was just the evolution of the exclusionary language in the insurance market. But typically what we see there is that, well, what we could foresee there is that if you have a multi-million-dollar, pound, euro business interruption loss, so let's take the power plant example, we'd be talking, a significant figure of a potential loss if the worst were to happen. It makes the outcome to adjust that claim very, very difficult, because the loss adjuster and the insurer and the broker and the client have to try and determine what amount of the loss stemmed from the cyber incident in the first place versus what was caused by the ensuing fire, for example. So consequently, that makes for a very, very difficult settlement of loss. And at the very best you'd probably get is, as I say, is a negotiated settlement. So, and generally speaking, when it comes to negotiated settlements, all parties come away with a feeling of, I didn't quite get what I want, or that wasn't what I was expecting, or that's not what I thought I was insured for. So it's not good for clients, it's not good for brokers, and it's not good for insurers. So collectively, it's not good for the insurance market. And that's really what we're doubling down on now, is trying to understand and assess and quantify that cyber physical damage loss expectancy, so that we can help clients, brokers, and insurers place protection cover for that loss.
Sure. So just a question off the back of that, really, in terms of, so if there is a physical asset that gets damaged, and clearly if that's integral to the organization, doing business, Would with the cyber cover that's generally included at the moment, would that cover them for the days that generator would be down, just not the physical asset itself? Or is it because of the physical asset being down, that's where the cover stops, because it is off because of that is uninsured?
Yeah, so under the definitions of the cyber policy, the cyber policy will define the assets that are insured under that policy, and typically that's computer equipment, data, etc.
Got you.
But it's not things like large value capital plant, or buildings, or stock, or contents, anything like that. So again, the cyber policy would respond to the, let's call it, the ring fenced piece of the claim that relates to the assets and business interruption insured under the cyber policy. But just to put this in perspective, typically we're talking a purchase here of maybe 10, 20 million euro, dollar, pounds limit under a cyber policy. If we think about the potential business interruption loss under a traditional property and business interruption loss as a result of a physical capital asset like a generator, you're talking a long lead time. And in these asset policies, you would typically have 24, 36 months so-called indemnity period. And that indemnity period is the period of loss for which you're covered for. So you can start to see that actually, even if there was a form of protection under the cyber policy, it would by no means be enough in terms of capacity and potential loss in the event of a big capital loss like that. So that's kind of how it's sort of split out.
Yeah, of course. That's interesting, isn't it? So why do you feel that there is a gap in the coverage for physical assets against cyber risk? And,
so
and what is the impact as well on the company's shareholders and people like you and I?
So essentially, it's very much evolutionary. Okay, so if we go back to when the Prudential Regulation Authority, which is the regulator that regulates the insurers in the UK, they were very concerned around insurer solvency, and the potential impact to insurer solvency as a result of an unexpected cyber loss. So traditionally, insurance policies were what they called silent on cyber, i.e., it wasn't explicitly insured and it wasn't explicitly excluded. So and that's what really sort of spooked the PRA. So they said, well, look, actually, they have what they call a Dear CEO letter, which they send out to all the major insurers every year. And within that, they said, look, you need to be affirmative on the cyber protection you're giving. So what that typically meant was either you need to exclude it, or you need to sublimit, or you need to, if you're going to include the cover, you need to price and capitalize for that so that your solvency ratios are protected. Typically, because at the time, when we're talking here back sort of 6-7 years ago, at the time there was no opportunity and no capability to assess what that cyber physical damage assessment, potential loss would be. Most insurers, understandably, because they couldn't really get their heads around it, they had to sort of exclude the risk. But again, what that then did was that then sort of, typically, when you sort of exclude one thing, that potential presents a new market for another more innovative carriers, and resultantly, Lloyds actually also split out between cyber liability, what we talked about earlier, that traditional cyber liability policy, so-called what they call CY, and cyber physical damage CZ. So, and then they mandated their own markets to be clear in terms of what they were insuring, whether it was CY, CZ, and you started to see the advent of carriers spring up to actually start to insure cyber physical damage explicitly. So giving clients the explicit cover. Now, when this all happened, as I said, this was sort of 6-7 years ago when this started. And at the time, it wasn't really deemed to be too much of a problem for clients, because at the time, OT was very much separated. But as we think about the rise of IT, OT connectivity, if we think about Internet of Things, all of those devices connected over a network. Once you connect anything over a network, there is a potential vulnerability and exposure. So consequently, we've now seen, as we wind on, we now start to see these cyber physical attacks almost pretty much doubling year on year. There's plenty of data out there around this, and there's plenty of reasons for it. It can be ransomware. It can be for geopolitical reasons. It can be for competitive reasons. If you can try and make things worse for your competitors, you can start to demonstrate that you're more robust than they are, for example. So that's sort of the advent of how we got to where we got to. And what's really interesting now is my colleague and Peter and myself have just been at FIRMA last week in Madrid, which is the European Risk Managers Forum. And there really is now a sort of a groundswell in the room that this is becoming a big protection gap and a big balance sheet gap. And the reason it's becoming a balance sheet gap, as I said, is that we now start to see connected networks and connected capital devices like we talked about the turbine. It could be, for example, offshore wind turbines. It could be solar, for example. And if we think about the investment into the digitized economy, you hear Rachel Reeves always talking at the moment around investing 18 billion in the UK Wealth Fund and the GB Energy, all of which will be into the digital economy. She actually uses those words. Well, digital economy by default means it's connected and it's exposed. So again, you start to look at sort of how exposure has changed and increased. And now, as I said, there's very much a groundswell of appreciation of the risk. And we also think about manufacturing. Most manufacturing plants have connected devices as well. So again, if a threat actor is able to halt your production, then obviously you can't make any revenue. So it's just the same as a service company. If it's a financial institution, if you can't use your computer equipment and you can't trade, for example, same thing on production. So if you're a complex manufacturer and your production is breached and halted, then same thing. So what's the impact? Well, so the impact is obviously potential revenue, loss of revenue, and obviously if you don't make money, then you don't make profit. And then obviously that impacts into shareholders as well. So we're looking at potentially downtime and reduced revenue and profit, which would naturally find its way into the share price. And then you start to see implications for investors, shareholders, etc. And there's an interesting example that we've just done. We've just done a big UK real estate asset. Total sum insured was about £2 billion. So this was real estate. It was built. So the insurance policy insures for buildings, loss of buildings, loss of rent and service charge. And we actually run this assessment, and we actually identified that the building management system was actually quite vulnerable in this particular asset. And consequently, one of the scenarios we could foresee was actually a potential total destruction of the asset. Now, that might sound a bit sort of, are you sure, is that really going to happen? Now, of course, this is worst case scenario, but what we're highlighting in what we do is we're able to assess the vulnerability of the asset and then quantify the loss. So what we're saying is that worst case scenario, this could happen. And if you think about that from an investor perspective, if you're investing, say your pension is invested into a fund that owns that asset, if the worst were to happen, all of a sudden that asset is destroyed. There's no insurance indemnity because the malicious cyber physical damage is excluded. And by the way, we saw the policy, so we do know that that is the case. All of a sudden, there's a 2 billion hole in that asset, right? And there's you're impacted, I'm impacted, etc. So whilst in the grand scheme of overall total assets under management, it might seem quite small, but if we think about it, 2 billion gap is big in anyone's purse. And we also firmly believe that this would actually also shock the wider financial market. Now, if we think about extrapolating that, as I said earlier, around the investment that Rachel Reeves and the UK government are looking to make into more digital assets, they're looking to put in around about 18 billion. When we add private capital, we're probably going to be looking at around about 80 billion investment over the course of this government. That's a heck of a lot of assets. So all of which will be into modern digitized asset, whether it's energy, transportation, net zero technology, whatever. So again, the risk is really rising, and the protection gap is rising, and the investor sort of vulnerability is also rising. And the reason that we're also interested in this is that we see a correlation also with the banking sector as well. Now, again, if we take the example of the real estate location that we did, if that was leveraged and secured, loans were secured against that asset, then typically the bank, would have the asset to, in the event of default, would have the opportunity to take over the asset, just like when you have a mortgage, your mortgage company says to you, you must insure your house. Same principle, right? But the challenge we have at the moment is typically that the banks are running this risk of uninsured loss, and they don't know about it. Now, this all sits under the UK regulator. So the Bank of England regulates both the insurers through the PRA and the banks through the Bank of England, and they have to regulate under the Basel framework, Basel III framework. And essentially, what that Basel III framework says that if you identify potential loss and potential risk on your balance sheet that you cannot mitigate, whether that's through traditional mitigation or whether it's through insurance or whatever, then you have to hold capital for that loss. Now, so consequently, that would create a capital load onto banks. But at the moment, because they're not aware of it, to our knowledge, they're not actually running that assessment. But we think that once they become aware of this, they will say and start mandating, actually, clients must start to insure for cyber physical damage as well, whether it's real estate, whether it's operational enterprises, manufacturing, etc. So anywhere where their loans are secured, because ultimately that could come back and hurt them. So that's where we think it will. That's where we'd like things to be going once they become aware of this, because from all of this, and we're not just saying this because it's good for Axio. Yes, it is good for Axio, but more importantly, it's about creating more resilience in the digital economy, creating a safer place for investment. The government talks about the UK being, number one place for investment for FDI. Well, you need to make it as safe as you possibly can then. And the reality is that this can be achieved by working with companies like Axio, who can do the quantification of these assets for cyber physical damage, and then working with, at the moment, it's the Lloyds markets that are providing the protection. But I do think also we're going to start to see much more interest in coming from company markets as well, because obviously they've got a huge client base, some really big manufacturing and complex clients that have this balance sheet need. So I think they will start to be a stronger demand for this, as just as awareness continues, as risk continues to rise, and hopefully as banks start to say, well, actually, we don't want to be exposed to this. We don't want to carry extra capital and the opportunity cost of that capital for this risk when it can be insured. So there's no need to be in the situation we're in right now.
Sure. I mean, to be perfectly honest with you, when you look at it, it's quite scary. It's a little bit James Bond villain-esque, isn't it? Somebody, everything's connected now. Everything's sort of on the cloud, so to speak. And if somebody can infiltrate your physical assets and just starts halting productions, and the possibilities are endless in a negative sense, really. And especially, as you say, if all of the wind turbines and everything goes sort of that direction, or even if it doesn't, in fact, if everything's just connected, if foreign I suppose hackers can get in, adversaries, could get in. It really is a bit of a scary James Bond situation where you could effectively affect everything, right? If it's water supply, if it's energy, if it's you name it. And when you look at the future, it's only going one way, which is great for efficiencies and it's great using the technology, but clearly it comes with massive amounts of risk to it. And I think just investment in general along this sort of line and the thinking of it needs to be front and center, really, more than it is at the moment, I would say.
Well, and this is the challenge, John, in that we need to create greater awareness also within government and in Treasury, because at the end of the day, the 17-18 billion is your and I taxpayer money. This is not free money. No, governments don't have money. Governments only have our money. Right?
Yes, of course.
So, there's a duty from this government and any government, but from the government to protect taxpayers. And then there is also, obviously, as I said earlier, around there should be a desire to create the most resilient place for investment. Now, we all know you can never eliminate all risk, you can never eliminate all fire risk, you can never eliminate all cyber risk, but you can manage risk and you can make it as safe a place as you possibly can be. And if we think about it, where we're at the moment, the cyber physical damage protection market is quite a small market vis-a-vis the cyber liability market. We're talking sort of hundreds of millions versus billions of the cyber market's around about 15-16 billion dollars globally. But the cyber physical damage market's probably below $500 million, I'd say. So consequently, because the uptake of insurance protection is still quite low, because you have a relatively small pool, the cost of the insurance is perhaps seen as being prohibitively expensive, particularly when it's seen as a discretionary spend. If we can get the banks to say, well, look, we don't want this risk on this balance sheet exposure on our balance sheets, because of the BAL capital loads, we believe that will obviously increase demand. And when you increase demand and you increase the size of the pool, you can then start to reduce the unit price of cost, because obviously you get a better spread. So you create a better spread in your portfolio.
Yeah,
so
of course.
I'm just saying, look, I've got 20 clients, I've got 20,000 clients. By default, you're not going to have a loss on every single client at the same time, which is obviously the way the insurance pool works. So you're able to lower the unit cost of insurance. And what we're not saying here, we want to sort of cut the market to bits, not at all. What we're saying is we want to build the market. So we want to, at the moment we have a very sort of verticalized market in terms of heavy concentration of risk. But if we can horizontalize that market, so say at one end we have the heavy risks like oil and gas, energy, etc., but on the other end we have like real estate, for example, where the likelihood of something like this happening and the really massive impact on total loss is very slim. But by the way, I can make the insurance placement so economic, why wouldn't you buy it? So it's almost like saying, why would you not buy accidental damage for your home contents insurance if it's only going to cost you 3% more? You just kind of buy it by default, right, to give you that comfort. So that's what we want to do. So it's very much around growing the market. Hopefully we're also going to get the company markets on board with this as well, in addition to Lloyds. And the great thing about this is that there is enough opportunity for everyone. It's not like a case of where if you bring more people in, you just really cut the profitability out of the market. What we're saying is we need all capacity. So by default, what we're doing at Axio is saying we can help you assess and quantify that loss expectancy, which helps you as an underwriter or a broker underwrite and place that risk, so we can determine minimum, mean and maximum loss expectancy, loss exceedance curve, average annual loss, all good things that underwriters understand. And the beauty about it is that we can do that by using existing data. So we're using the existing property damage schedule, which clients are using for their insurances, their property insurances, the existing cyber questionnaire, which they use for their existing cyber insurances, and or if they have a framework that they've already run an assessment against, we can just ingest that as well. And then using the engineering reports, we put it all together, we build the scenarios applicable to the industry code, what we call NAICS code, which is an industry code. So making sure that we're building scenarios for the particular asset. So, and by doing that, we can do, if I take the real estate example, we can determine loss scenario and expectancy, not just because it's an office, but because it's an office and because that's the threat vulnerability of that particular asset as assessed by us.
Can I ask a question on that then? So as you're assessing the risk, is there, would you be able, or would somebody be able to read the data that you've sort of pulled together and improve their risk effectively? Would they be able to say, okay, so here's a black hole, or maybe we could do something around this, and then maybe take it away and look at different technologies that they could use to sort of shore things up for themselves as well, right?
Absolutely, yeah, because essentially what we do is on the enterprise side, that's exactly what we do. We look at where you are today, and then we say, look, these are the control levers that you can put in place to bring that loss expectancy down economically. So making sure for every pound, dollar, euro you invest, you get more than one back, right, in terms of loss reduction, right? And same principle here. We build scenarios based on the vulnerability of that asset, and if that vulnerability is due to easy access, for example, or a
Yes.
particular network or whatever, then the client can then say, well, actually, look, we need to do something about this, and we can bring that down. And if we can take that out, we can take that sort of threat vulnerability out, then yeah, we can actually rerun the numbers. Well, interesting, we done an assessment for an Australian dairy company, and these are sort of countrywide in Australia, and we assumed that the refrigeration plants for this particular client were not connected, right? Because obviously they're dispersed over Australia. So we made the assumption that they weren't, because we didn't have anything concrete to say to tell us otherwise. And then when we ran through the report with the client, we said, look, we've made the assumption that your plant is not connected. And they then came back and said, well, actually, no, it is all connected because it's all managed through one managing company. And therefore, all of these refrigeration stacks are connected across Australia. So subsequently, that creates a massive risk. And we had to rerun all the numbers. And naturally, the loss expectancy went right up. Whereas what they could now say, well, actually, look, maybe we need to review the actual connectivity and remote monitoring of all of these connected refrigerators. Maybe we should change that, even if we just compartmentalize some of it, for example. So absolutely, yeah, it's always iterative. There's no sort of, we're providing an assessment and quantification in time based on data we've got. But as with any risk, it's an opportunity for clients, brokers, and insurers to work to reduce that risk, and that will evolve over time.
Of
We're
course,
still
yeah.
sort of early days in this at the moment.
I think as well, awareness, it's certainly not something that I would have thought about. It's not necessarily something that I would have thought of would even be achievable for somebody to hack into systems and take control of physical items or physical, machinery. So it's really sort of interesting. I mean, I suppose one sort of final sort of question on it is, do you think that the government should look at maybe putting something in place as or in conjunction with the regulator to make the physical damage insurance something that is, mandated? Or
So I think it's very difficult for governments to necessarily mandate insurance, with the exception of things like, third party motor liability, for example, or employers liability. But I think, and in this country, we tend to sort of work around a code of practice. So, it's sort of incumbent on us. We were in a meeting yesterday, an insurance meeting yesterday, where, everyone was in agreement that cyber physical damage needs to come to the top of the agenda. Because what we're talking here, we're not, when we talk about liability and fines and damages, for example, around exfiltration of data, if someone takes your data, don't get me wrong, it's sensitive data and it's damaging, right? Personally. But it doesn't necessarily stop the company working, right? What we're talking about is we're saying that actually, if your assets are breached, your company comes to a standstill potentially, and or you're not also indemnified, and you lose that asset altogether. So, at the end of the day, if you can't run your business, don't worry about being able to pay a fine or not, because you're out of business and you're insolvent, right? So I think but I think for us, like you said, it's around raising awareness. We also want to raise a better awareness with Treasury. Particularly around the investments that they're putting into this digital infrastructure, and I think there is a proven sort of linkage between clients buying insurance and actually improving their cyber resilience, because obviously insurers have a certain threshold of acceptability, and if clients don't meet that, they either don't get insurance, or they need to get to that threshold before they can get insurance. And we've helped clients do that as well. So I think, it will lift all boats, but I don't think we're going to get to the point where it has to be mandated. But I do think it is incumbent on the government and the Treasury through the Bank of England to raise this point with the banks, because the discussions I've had with both the BAL committee and the Bank of England themselves have basically said, well, look, yes, okay, we get this, but we don't think it needs to be addressed because the framework will address this risk, which it will. So there's no denying that. But obviously, the Bank of England says to banks, you need to run your risks within the framework, but it's incumbent on you to determine what those risks are. Now, if you don't know about those risks, how on earth would you ever run those risks through the framework? And it could be that some of them say, look, actually, I've run through the framework and I'm happy where I am. I'm happy with the situation. But my belief is that, most of them would turn around and realize they have a potential capital exposure there, and would then start to change the way they think about lending and securing credit. And again, if we think about project finance, project finance by default is an investment into an asset that might have, say, a 20-year lifespan, and the capital investment and the loan into that infrastructure is paid off through the lifespan of that asset. Maybe that's 20 years. Whereas if that asset is destroyed in year 5, you've lost 15 years worth of earning generation. And by the way, the asset is destroyed, it's not insured, it's not reinstated, bang goes the loan. Because typically these companies will be special purpose vehicles. They would simply be liquidated and that would be the end of it. So the banks would be on the hook for it.
Yeah, and I think realistically, when the more awareness that it gets, I think it just makes common sense from a business perspective anyway. Why would you want your physical assets being at such risk? You're investing a hell of a lot of money into your physical assets, so it should be part and parcel of common sense, I guess.
Well, exactly, and as a board, as a member of the board, you have a duty to actually manage that exposure, right? Particularly if you have shareholders, right? You've got a duty back to your shareholders. So this is why we also see potential impacts into directors and officers insurance, because if enterprise clients are not managing this risk to the degree that they should be and mitigating this risk to the degree they should be, then there is a potential, in the event of a loss and then a downturn in profit, etc. There's a potential ramifications into the board and consequently into the directors and officers insurance policy.
Yeah, of course. I mean, unfortunately, Gavin, we are running out of time now, pretty much out. So I think the only thing that's left to say is thanks for coming on to the Impact Room. It's been great to have the conversation with you. And like you say, I think awareness is the first step in tackling the threat that is physical cyber insurance, really, because until you really sit down and think about it, until I had that conversation with you, I wouldn't have thought about it at all. And like I said, it's pretty James Bond stuff, right? If hackers can get into your physical machinery, you're at massive risk of ransom of anything, really, right? It could literally bring the country down, which is scary to think of. But like you say, we're in the initial stages of it. It looks like it'd only go into one direction. So the awareness of bringing the lack of cover in this area, I think, is quite important, because I know for a fact that a lot of people would get cyber insurance and that's it. They wouldn't necessarily think that half of it's covered, half of it isn't.
Exactly. That's a really moot point, and even professional risk managers we've spoken to get confused between cyber liability and cyber physical damage. So that's absolutely critical. So if nothing else, John, just the opportunity to come on here today and talk about that and just make people aware of it. But most importantly, this doesn't need to be doom and gloom. This is around creating a more resilient investment market. So the market can handle it. The market's building. So what we're just trying to say is, look, we don't need to have this protection gap anymore.
Sure, and I think that the other positive that could come from the back of it is when people start thinking about how much risk that they're under with it. And like you said, with the assessments that happen, there are certain things that you can make yourself a lot stronger on, just prevention. And prevention is often the best and ideal solution, right? However, I certainly, if I had multi-million pounds worth of physical assets sat in my business, I wouldn't want to put them under the risk of being taken away. So common sense really prevails. But look, like I say, Gavin, really appreciate your time. I want to thank you for coming on to the Impact Room. And if anybody wants to speak further to Gavin, I will put your details on the social media accounts and stuff like that. So anybody feel free to reach out to Gavin for more information or conversation and see how I might be able to help you. So
Yeah, you can find me on LinkedIn. Always happy to have a chat with anyone. And just from my side, John, thank you again.
Yeah, no problem. Thanks a lot, Gavin. Cheers.
Yeah. All right.